We drove up prices, shooting inflation into the stratosphere. The government was really slow to react, thinking things would self-correct. Oh, how naive, government. And as you know, in 2022, the music stopped, the party came to an end, and a lot of people were left without a chair. Hi friends, this is Colin Richards, and once again, I am thrilled to be with you on this episode of the Lord and Richards Show. And today we're going to be diving into current opportunity in the midst of volatility. You know, whether we're in smooth markets or really rough seas, we can count on the fact that the market is a place of opportunity. But the trick is, how do you find opportunity in the midst of volatility, right? So when markets are choppy, when the seas are getting a little high and it's starting to make us a little sick to our stomach, are there still ways to seize and capture the opportunity of the market? And the answer is an unequivocal yes, there are. And every single day at Lord and Richards, we are helping people just like you to retire completely carefree. We are helping people to build a comprehensive plan that will help you to rest easy and sleep well and enjoy your life, knowing that you have a plan in place that can deal with all kinds of circumstances, both good and bad. And we're doing that every single day. As kind of an introduction to the solutions part of this episode, I'm going to give us a quick history lesson, right? It's good to put things in context. We had a lot of enthusiasm going into 2020. And as you know, the pandemic really squashed that. But for some reason, you know, the emotions of the market, as we bounced out of that and as the government poured over $7 trillion into our company, people went a little crazy, right? With all this cash on hand, people are buying goods, driving up the prices. There was this irrational exuberance that Ben Bernanke, the former Fed chair, talked about prior to the dot-com bubble bust of 2000. And the same thing was happening. And so we drove up prices, shooting inflation into the stratosphere. The government was really slow to react, thinking things would self-correct. Oh, how naive, government. And as you know, in 2022, the music stopped, the party came to an end, and a lot of people were left without a chair as markets tumbled over 25% in both the stock and bond markets. Places that were traditional safe havens, once again, just like in 2000, just like in 2008, became places of volatility and disaster. And so we've got to learn the lessons of history, right? Markets are going to be volatile. They're going to come back and take a swipe at us every few years, and sometimes it's going to be a really bad one. The question is, are we prepared in advance this time? Right? Inflation has gotten back under 3%. The markets are doing their normal thing of correcting and then surging. They're acting pretty normal. Yes, politics are fomenting volatility, but that's to be expected. All of this is normal. So now that we are back to a new normal of pretty normal inflation, higher than normal rates, I will say that, what can we do to really build up and insulate our position? So growth on the one hand, safety on the other. So I'm going to be talking about how you can be rewarded and not take unnecessary risk. Isn't that the holy grail, right? Everybody's trying to figure out, is there a way I can participate in the market and not take a lot of risk? You know, I had a client the other day say, hey, what do you think about this stock? And I said, you know, that's a stock. If you want to buy a stock, you're going to take company risk, you're going to take market risk, all of the things that should lead you to be a little nervous if that's money you can't afford to lose. But there are ways to invest in the stock market. There are ways to capture the opportunities when they're there and to do it in a much, much safer way. After the Fed kicked in higher interest rates and really started to punish us, that's when the markets really reacted back in 2022. Of course, we had the war with Ukraine, between Russia and Ukraine getting going. We saw borrowers getting punished as those rates went up. People who were trying to buy homes got punished, but nonetheless, the housing market remained resilient. And we saw the typical portfolio of 60-40 stocks to bonds or bond to stocks, depending on where you are in life, get wiped out. Simultaneously, both stocks and bonds were down. And the word unprecedented began to be used too many times. But a ray of sunshine broke through at that time for our clients. People who chose alternatives to bonds for safety were not only protected from the bear market right through 2022, but are now being positioned for one of the greatest opportunities for savers in history. And that opportunity is still in place, amazingly. The government, by keeping rates high, has pushed inflation down. And I want to tell you how to take advantage of that and how to be truly rewarded. Most of us are familiar with the ways that savers have typically set aside money, right? People who are trying to find an alternative to the volatility of the market, emphasizing safety and taking growth and setting that to the side. Places like cash, right? In your bank account or underneath your mattress or buried out back underneath the old oak tree. Government bonds, treasuries, and so forth that are guaranteed by and backed by the full faith and credit of the U.S. government, but typically at pretty low rates. Bank accounts, money market accounts, CDs, places that you can put money where you have some kind of backing, like FDIC insurance. And then the backing of the insurance world in places like fixed annuities, right, where you get a guaranteed rate of return, very similar to a CD, but backed by the full faith and credit of the insurance companies, as well as the ability of the state to actually back up those types of accounts. And then cash value life policies, which have been used forever to stash cash and let it grow tax-free without any downside, right? No downside participation in the market, all these places. But what they suffered from in the past was just a long spate of really low rates. Savers were punished and punished and punished. And so in the past, these low returns were the price to pay if you wanted peace of mind. And generally, adding these things into your portfolio meant putting a drag on the portfolio's performance. And many advisors just avoided them for fear of underperforming. They didn't want their clients to accuse them of getting less than some stock market index. These are the places people have gone. And in the past, definitely places where the opportunity was mixed, right? The insurance-based tools tended to give a better performance than the bank or the cash or the government-based tools. But that's because they were backed by the full faith and credit of the insurance company, and the insurance company had the ability to take those same government treasury bonds, cash, and other types of accounts and get higher yields on their overall investment portfolio. So in our next segment, I'm going to tell you why the tables have turned, why these vehicles may be something you want to consider adding in to your overall portfolio. Because at Lord & Richards, what we're doing every single day is teaching you how to be safe, but also to grow at the same time. Usually we have to separate those out, right? Dollars that are safe don't get to grow. But in our next segment, we're really going to dive into this. In the meantime, I want to talk to you, have a conversation with you together with my team, and help you lay out a path to real retirement peace, real retirement carefree journey. That's what we're looking for, and that's what we do at Lord & Richards every single day. It simply starts with a phone call.